All right. Hi, everyone. Thanks for joining us. Today, we've got Darcy Ungaro from Ungaro & Co. and the New Zealand Everyday Investor podcast. I think this summarizes what I love about the industry is that Darcy and I run similar businesses or we cross over in the services that we have. And what's so awesome about the industry is that we just chat. Everyone gets along pretty much. So welcome, Darcy. Thanks for coming on.
Thanks for having
I'm
me.
just going to do the intro screen and the all-important disclaimer. So hold 1 minute. All right, that is the disclaimer. Don't take anything you see in this video as gospel truth and specific to you. It's all generic. So hi, Darcy. Thanks for joining us. Tell us first of all a bit about your podcast because it is awesome.
Cool, thanks. So we started the NZ Everyday Investor I think it was around about 3 years ago, right? And I was talking to my wife about this just like 2 nights ago, saying, "Hey, I'll give it a year, see how it goes. If it really distracts, me so much that my business starts to crumble apart, then we'll rethink about it." My main goal was just, hey, can I do this thing and still operate a business sufficiently without getting distracted here? That was kind of what my primary goal was at the start. And then as time went on, it kind of started to evolve where I started to speak to more and more people off the back of that. Not that that was necessarily, I don't think it was the original intention, but that's kind of what justified me spending a lot more time. But I kind of think of it as, hey, I'm number one, I'm doing good. Number two, I'm doing my professional development publicly. And number three, it's just like fantastic to catch up with people like yourself, but also like key people within the industry that normally you talk to them in a commercial setting and they've got their commercial sort of frame of references on and stuff like that.
Yeah.
But actually talking to them about what they really think is, I think, so critical for learning, especially with where we're at right now, where it feels like all the rules are kind of being tested. What is really going to work in the new world, we're not so sure. We all have our thoughts, but often it's hard to see that when you go to the mainstream sources.
It is, and we are in an industry where people are information hungry, right? And it's constantly changing. To keep up is a full-time job for us, and so for the public, it's a nightmare, right? So it's really cool to just get the information out there.
And it's weird, isn't it? Because there's this weird lag, and I didn't see it so clearly before, but I know that a lot of people who are probably trying to consume media around them, they probably get a sense for it as well. I think maybe that it just feels like there's a big lag between reality happening and then everybody talking about it and accepting it for reality. And I think that's why these sorts of conversations are so key, because you operate with a team of advisors all over the country, so you know what's going on right now. I know what's going on right now in my sort of circle of influence, what I can hear and see. But you're not going to read about this for a few months. Generally, that's why, like, stats great, data's great, but to a point.
The stats take so long to get through that, it is really interesting. And I think probably our first discussion topic will relate to that. So the Triple CFA, the Credit Contracts and Consumer Finance Act, which officially came into being on the 1st of December last year, but was being implemented by the banks from about September. So that is a classic example of the minute it hit, people that worked in the mortgage advice industry like you and I, we knew what it meant. But from the public's point of view, it started trickling into the media as we sort of announced those kind of changes, but it took a long time for people to appreciate what a vast difference that it made, right?
Yeah.
And I'm on record and have been sent multiple emails disagreeing with me, some in capital letters, fair to say. But I'm on record as saying that I think the Triple CFA is what caused all of the problems that we're facing the majority of the problems that we're facing in the New Zealand property market at the moment. There are interest rates and loan to value ratios and the threat of debt to income ratios, but
Mm,
realistically, we saw, the applications that were in August, we'd send it off and that it would be fine. Got to September, October, and the banks told us that around 70% of the applications that mortgage advisors thought would pass that
mm,
sent to the bank were being declined. That is a general removal of the ability to get finance in the market. What was your
mm,
kind of experience over the past
mm.
9 months,
Great
essentially?
Yeah, great question. Like, I think on the YouTube channel, I can't remember exactly the name of the title of the video, but it was like, "Will the triple CFA crash the New Zealand economy?" I think is what it was. So this was in
Yeah.
September, right? Now that came off the back of a conversation I had with a client I was working with at the time, where he was told one thing from, I won't name the bank, definitely not, but he was told one thing from the bank, and then something completely different from me. I was using the new rules because we had to, right?
Yep.
I don't know if the bank was using those rules, to be honest, right? So I'm just putting it out there carefully.
I could
Big,
almost guess which bank.
you could. So that kind of came up, and I'm like, I was scratching my head. The client, understandably feeling frustrated, confused, scratching their heads as well. How can this be? We're getting two different answers. We're talking from the same bank. And yeah, it was the application of the triple CFA rules. So I'm of the view, and so I did a video, a bit of a case study on that, showing the actual amount, the difference. For me, that was when the penny dropped, right? So this was going back almost 9 months ago now, right? So 9 months ago, the penny dropped that we have a massive problem and nobody's talking about it yet. We're all still in la la land with property prices, and we've got a housing crisis and yada, yada, yada. But that was, for me, I was thinking we've got a real problem because there's two things that affect house prices in New Zealand, in my view. Number one is interest rates, and number two is the availability of credit. So the cost of credit, the availability of credit, and we've had both of those interfered with massively in the last 12 months, and we're seeing the impacts of it now. Again, with that delay, so many people, like we talked about at the start, so many people were making decisions with 3-month-old information. And now they're finally starting to go, wow, this is actually happening now. Wow. But yeah, it's actually even a little bit worse in my view, because yeah, they've made amendments upon the amendments of the triple CFA, but it's in my view, and I'm not sure what you think about this yet, Rupert, but in my view, they need to throw it out. It's absolute garbage. It doesn't make any sense. It's completely nailing the wrong people. And my speculation goes even further in that this is a really convenient tool to bring about the crash of the New Zealand housing market, which is actually by design. And that's my very spicy view. I'm not saying
It
it's
is
by
very
design
spicy.
because they're trying to destroy everybody, not that far, but
Yeah.
they wanted to bring it down. It's so much easier to crash an economy than to build it up, and they're doing the easy thing. That's my view.
Yeah, mine wouldn't be that far, but,
Oh, go on,
whether they
Rupert.
meant well, whether they meant to or not, it has
Yeah,
done it. And it's even more delayed than you think because, the people that sure, there were people applying in September and getting declined, but there were also people in August who had a 3-month pre-approval who kinda had the old rules and then in December realized that suddenly they couldn't borrow again or the rules had changed and, everything
yeah,
was different. And then they kinda take a few months to believe it. So it was, yeah, as you say, February, March earliest before people really recognized the impact of this. There
and
was
that's
a
not good enough, right?
no, well, it's always gonna be until we get in live stream statistical data, I think that's
Yeah,
always gonna be the thing. That my problem with the triple CFA, I like the triple CFA for the fact that it personally goes after the directors of scoundrel lenders, right? And we have had a
totally.
client who was paying 30% per month of interest,
Wow.
per month of interest. Those people cannot hide behind companies and they
Yeah,
need to be hunted down and put in jail, right?
yeah,
The problem is that the banks who have a huge number of other regulations on them are also fall into this category. So they were responsibly lending. They have all these checks and balances, but the directors
mm,
of ANZ or whatever are still personally liable. You can't get PI cover to cover yourself out of it, literally out of their own pocket. So don't know if I'd bin the act because I think the general direction is correct, but I
Mm,
think you would make mainstream lenders exempt from it because they have a whole bunch of other issues.
mm. Yeah,
Even just that they're
it's
listed. Yeah.
yeah, yeah, and it's kind of like the what's that called? The something window. Um, like there's a range of acceptable views around this topic, and forgive me for kind of putting that out there so strongly, right? But I think
Oh.
the open window. I think it's really important to really push hard on this one to really shake people's thinking out of this. Whether it really is by design from the start, which even I don't fully believe that if I'm honest, or whether it's an absolute garbage piece of legislation that they permitted to stay in existence because it
Mhm.
accomplished an existing goal that they had, that's probably closer to where I'd sit. But I think that this is something that we should have been talking about a lot louder as an industry. There's some players. I can think of John Bolton from Squirrel, who was really
Yep.
vocal around this, which was awesome. And but I kind of feel like obviously the bank players they're kind of in a difficult position. Everyone's afraid of regulators. Everyone's afraid of saying something wrong that they shouldn't or that's inaccurate. No one's speaking their mind. No one's able to actually have free discourse and throw around ideas because they're too afraid of the consequences. And what am I going to get out of it, right? Or what am I going to lose by speaking my mind? But
Yep.
this is so fundamental to like getting credit is how we grow an economy. That rightly or wrongly, our economy grows because the creation of new credit. And when you turn that off, businesses fall over. Households, they have to
Mm.
sell things at the worst possible time. Things there's second and third order issues that arise from this. So
Yeah, I mean, I think if you wanted to cool the market, which the government definitely did, and you would not want another 30% year of 30% capital growth on houses, right? For if you're a first time buyer or something. If you wanted to cool the market, there are so many other levers. Typically, the one was interest rates, and you can see, well, they're using that to control inflation at the moment. But typically, it was interest rates. You bump it up, people stop buying houses, stop spending, and that we've got loan to value ratios, debt to income ratios that can be turned on and off, and that's the important differentiation between loan to value
yeah.
ratios, which you could make it so, and I do not support this. Let me be clear. You need 60% deposit to buy an investment property, right? So rather than the 40% at the moment, you can turn off that bit, or you can 30% deposit to buy an owner occupied, and you can turn that on tomorrow and turn it off next week, and that
Mm,
cools the market in a much more controllable way than legislation, which takes obviously 9 months when it's really broken to fix. And so,
yeah,
but I,
that's right.
yeah, I think
If we
someone
could take
wanted
it
a
good,
legacy, and
yeah, it wouldn't
and
be that.
yeah,
But I guess like there are like, and even when I had this conversation with John Bolton around this, like the spirit of the triple CFA in in applied in its correct environment is awesome. It's great, does good things, and I think that's kind of what you were saying before as well. But the unintended consequences is what I'm really concerned about, and just how
yeah,
like maybe with other types of legislation as well, things that were put in a haphazard way with speed without actually testing to see what the previous changes were going to be. Tax
yeah,
changes, healthy home standards, interest rates, LVR shifts, all of that stuff. And that those are phenomenal changes. And then you
big
allow a
changes.
bit of legislation like this to go through.
Yeah,
Like if
yeah.
that is not, I don't know what that is. I can't say it's incompetence because I don't know what the headspace is, and that there's reasons why they do what they do, right? But
Well,
man, it just
so
it
I
just
think
seems
one of the problems was that all of the banks went to the government and said, "Hey, these are going to be your problems," and financial advisors went. Um, this is prior to the act being implemented. These are going to cause a number of problems, here are your problems. But from the government's ear, of course, the banks would say that. All the banks want to do is make money, and that's their kind of big myth, right? Is that you just want to lend until no one's got any more, and
yeah,
so it's that was the problem, right? The government would have heard, of course, the bank wants to make it easy to lend, but
yeah,
realistically, they were right. And a big shout out to John Bolton as well because he
mm,
started that petition, did a huge amount of work for it. And if we get these changes in this year, I mean, well, the first round of changes come in the 7th of July,
yeah.
the 22. But if we get it actually sorted, it will be primarily because of the work he did. So yeah, he did
Yeah.
a huge amount of work on that. Mm.
Yeah. So it's interesting. I don't know what the answer is. Like, I'm not suggesting that there was a better option for them to do, but I just kind of feel like they probably should have waited. And when I say they, let's be specific, right? We're talking about the Reserve Bank and the government, right? Through the monetary and the fiscal arms, or the different sort of ways that they corral us. So the
Yep.
the interest rate thing, I personally believe that would have probably done the trick. They should have hiked sooner, in my view. They shouldn't have dropped so much. And this isn't just a New Zealand thing. They
Yeah.
should have maybe thought for New Zealand, not so much whatever other central bank was doing. But everybody kind of did the exact same thing, irrespective of, like, we all had the same medicine, irrespective of the severity of the illness in so many ways. And that's again something that we need to talk about. But that could have been enough. The interest rate lever. Why all of the other things? Why all at once? Doesn't make sense.
Yeah. Yeah. So that's probably the next good topic to discuss, because I mean, inevitably, anyone who is in the property market at all, whether they're buyers or current owners, are aware that, this time last year, 2.09, I think we got at its lowest very briefly.
Amazing, eh?
Yeah, yeah, totally right. 6 months later, we got 4.4, I think. It basically doubled. And then now this week, we're sort of at 4.85. I always talk about the 1 year rate because that's
Yeah.
less frightening than the floating rate and the
Yeah.
cheapest of all the fixed rates. So
Yeah.
that's my anchor.
Yeah.
4.85, I think it's 5.19 for 2 years.
Yeah.
Huge difference. There's always a little bit of confusion around how interest rates are priced. The view is that it's strictly in line with the OCR, which isn't terribly true, which isn't exact. It's correlated, would be the fair thing. But yeah, what are you seeing out there in terms of interest rates?
Yeah. So it's just thinking this through out loud, right? Like, it's in terms of where things are going, or because like, I
Well,
think there's a lot to that, right? But in
yeah,
terms of the impact
let's
it's
give a
already had.
nudge at a forecast then, eh?
Yeah, well, let's throw away the science and the data and just talk about what we really think, right? So,
Totally.
yeah, so I think, like, if I was a betting man, which of course I'm not, I'm a financial advisor. I don't bet at
Mm,
all. We take
mm,
calculated risks. But if I was a betting man, I'd suggest that things might get a bit darker before things get brighter. From where I sit, though, I can start to see the glimmer of hope. So, as negative as I am on what got us into the situation, and almost kind of overflowing with a bit of righteous anger on some issues, I still feel like there's a very, very bright light at the end of a tunnel here, but we do have to get a little bit comfortable with how dark things might get before we can start going through that tunnel. And what I can say with many households in New Zealand, with the people that I talk to anyway, is that people are far more resilient this time around. And when I say this time around, compared to, say, March of 2020, when people were like, what the heck just happened? I don't even have any savings, let alone whatever. People are more resilient. They will be a lot better than what they think, is my number one suspicion. My number two suspicion, though, is that things will get a little bit darker from here on in before it gets better. And I guess number three, I'm starting to be a lot more optimistic. And again, just like what you're saying, we're seeing things happen right now. I can see now that the numbers are starting to get within range where, if you are bold, if you are a convicted investor, if you are happy to be concentrated in property, then very soon, maybe even right now, maybe it's a little bit too soon, but very soon, I see this as the beginning of an awesome time to be accumulating with property and other mainstream investments, or high risk investments, to be honest. It's not yet, but it's very, very close in terms to being a situation similar to what we saw in 2009 all the way to 2013, where nobody talked about property anymore, but it was the best time to buy.
Yeah.
That's what I see coming up. And I think the interest rate piece is critical, because interest rates, no matter how you want to package it, I believe that's the number one influencer on property prices. Property, it's kind of like a bond. As the interest rates go up, the value goes down, and vice versa. So we're now cranking interest rates back up to levels, what you were rattling off before. That sounds to me like, I haven't actually looked into this, 2009, I don't know, 2018, 2019 interest rates.
Maybe around there. Yeah. Yep.
Listeners would do well to kind
I
of
don't.
do
Yeah.
their own research, right? But
See,
my kind
seek
of
us
view
out.
is that, was that sorry?
Seek other data for this.
Yeah, yeah. That's right. But my kind of view is that the interest rates will normalize. They'll level off, but I think they've overdone it, and they might need to come back down. But they'll come back down when this inflation dragon is slayed. We often make the mistake, myself included, that interest rate rises or increases is all about trying to control the property market. It's not. It's
Mm.
about controlling inflation. It just goes
Eh,
through the property mechanism. So
yeah.
that's
I
why
mean,
we
it
kind of just
was
have.
in 2008-ish. It was all around the property market.
Mm,
This time round is definitely inflation. Inflation's a funny one, right? So inflation is something that economists worry about in the beginning
yeah.
and consumers worry about a year down the track, right? Because
That's a good way of putting
I,
it.
I
Yeah.
mean, and look, unlimited empathy for anyone who is living paycheck to paycheck, right? But if you're not, and your cheese goes from $18 to $20, which is a 10% jump, do you really care? Like it has a market effect, but economists are way more worried about inflation because they don't want to see 3 years of inflation, right? And then suddenly everyone's paying 30% more than they were.
Like,
But
but
what
just to interrupt, like, economists love cheese. That's why they're getting so cheesed off, right?
and
So,
alcohol.
as we
Yeah. So, yes, but that dictates the interest rates this time round. Is yeah,
yeah.
they
I think and
and
it's just this mindset that we're in that we have to always remember that it's not always gonna be this time is different, but we have to be open to
mm,
the possibility that it might be different. We have to look at things for what they are, not what they were last time. And inflation is significantly like that's front and center of regulators. Central banks are focused on inflation. So we kind of have to
yeah,
almost take them at their word there, right? They're gonna deal with it, and they're gonna do whatever the hell they need to do to deal with it. And property could be a casualty here.
yeah. But on the back of the inflation, it's obviously not been a great time in the stock market, right? So, which seems to be a little bit because of that, also international
Yeah.
events and say Ukraine and things.
Yeah.
What are you seeing in that kind of market?
Yeah. So it seems to be like, I don't know. And this is me just spitballing, right? So
Mm,
I don't know if this is necessarily true, but it almost feels like in some countries they have their main vehicle, right? So in New Zealand, it's property. That's what,
yeah,
if you can, you're gonna build wealth through property. Not that you have to, but a lot of people choose to do that. In the United States, though, for example, it might be property, but it's probably going to be more shares. It's going to be more share market. And then, of course, you've got these alternative assets like crypto. So
mm,
what I kind of see happening is that the higher you are in the risk spectrum. So when I think about a spectrum, I think about like a conveyor belt of things or a line, a spectrum, property, shares, crypto in terms of
yeah,
risk. But when you use leverage, you take the property basket and you actually swap places because you're amplifying the returns and losses and
the
therefore the
outcome.
volatility on the property asset class. So what we've seen, I think, with the increase in the interest rates is we've seen the spearhead of the riskiest assets being hit the hardest. So even Bitcoin in particular has dropped a phenomenal amount. I think this is like a godsend. This is the best possible time if you want to be accumulating Bitcoin, right? $20,000 US is what it was yesterday when I looked at it, which is amazing.
Down from
So
about 80, right? So
down from about 65 US, yeah. So it's
55,
it's
80 New Zealand,
phenomenal.
yeah.
Yeah.
Mm,
And then with property, I think because of the impact of leverage, it's again a lot riskier in a sense than shares that don't have the leverage element applied in most cases. So I think that that's kind of what we've seen. We've seen crypto hit, we've seen property hit. We don't see property so well because it's not as a liquid of a market as the other ones, and so you can't see it. It's quiet. But shares are next, unfortunately. The Grim Reaper's coming, and I'm not suggesting that we're going to see a bloodbath and sell everything. Please do not do that, but that is the possibility. So that's the interesting connection here with the way that the monetary system works. I believe is that the property in New Zealand, shares in the U.S., those are they feel like they're the avenues where credit creation seems to occur in those spaces. And in a way, I don't know how to say this, but it feels like central banks will either create new currency through a government channel or through the asset channel, and they've swapped from the asset channel through to the government channel recently, and they'll swap back once the inflation piece is dealt to. That's kind of, so there's these weird sort of dynamics that seem to be happening, and trends that you can see. But going back to your main question around the assets and what I see with the interest rates will unfortunately bring a lot of assets down, because the price of money does influence the price of assets. The assets are the
Yeah.
sponge that soak up that new credit creation. Right now, those sponges have already been wrung out to a certain degree, and that money is now operating in the economy, creating inflation. That's not directly exactly how it works, by the way, but that's kind of how I visualize it. We need to mop up that extra liquidity now. Interest rates going up, taxes are higher, harder to get new credit creation happening. People are repaying debt, credit dies. So that's kind of, this new equilibrium is starting to be reached a little bit, but it's a journey. I don't know how long that's going to take.
Yeah, typically many months, and I think, well, certainly before we see the results again. Yeah,
Yeah,
yeah.
what
So
do you
if
think,
you
though?
had,
Like to flip it around and reverse it, because I'm keen to know what you think as well around the interest rate piece. Like, if you were to say, thinking in the next 12 months, and kind of visualizing where rates going to go, do you feel they're going to get a lot worse before they get better, stabilize, or what do
that,
you think?
that was going to be my next question actually. So if we had to
You go
lay a
first.
bet down, yeah, I'll go first. All right. So let me preface this by saying that anyone who is forecasting more than 2 years out, I suspect is making it up. Well, actually, we're making it up more than about 2 days out. So, but 2 years. I mean, look what can happen in 2 years.
Mm,
Cast your mind back 2 years, and look what can happen. Right. So, your ability to forecast the economic environment with any assurity is fairly limited. What we do know is that the Reserve Bank forecasts further OCR rates and rate rises, which tends to raise interest rates through a variety of mechanisms. Um, the triple CFA, so I'm talking just mortgage interest rates
yeah,
for me, right?
yeah.
The triple CFA is going to be band-aided but not fixed. So finance might be slightly easier, although the banks are starting to make murmurings about they're not very happy with it and aren't really going to change anything. But you'd think that at some point they're going to become a little bit happier about their liability and their lending, so finance might become a little bit easier.
Mm,
Um, my guess is, so currently thinking the 1 year rate is 4.85. It wouldn't surprise me to see a 5.95 in about a year's time, year and a half. So knocking on the door of the 6. Going any further than that, that would seem that they haven't got inflation under control, which all the signs point to them actually having it under control. Well, it's certainly people dialing back on spending, which is the main cause, right?
yeah,
So worst case scenario, I would think 6 in a year's time, but then a retraction, and I think you'll see a long term kind of return of about 4.5 being where interest rates settle. Yeah, I'd say forget the days of 2. Those are gone. But I think
yeah,
if you would aim for long term to be in those mid 4s, which is kind of where we are now, right? But of course, as people
yeah,
pay down their mortgage, that gets more achievable.
yeah.
Yeah,
I like it. That's good.
that's my stick in the sand.
Yeah, I can. Okay, well, let's both make a
16th
mistake by
16th
putting it
of
out there.
June,
Yeah, that's right.
22. That was
Yeah,
give me a
let's
call in
quote the
3
start
years.
date. Yeah, that's right.
Yeah.
So on this date, Rupert said that it's going to go up
Yeah.
to something just touching 6, maybe in a
Yeah.
year, and then maybe settle back down to 4.5. We're not going to see what we've seen maybe for a while. So
Yeah.
I'm gonna go next and make a fool of
Go.
myself as well, Rupert, because you got the guts to do that. So why not? I got to throw my 2 bits in as well. So I kind of see something not too dissimilar to you. I would call it more like a tick shape, because I kind of see that this is going to get a lot darker, a lot faster than most people realize, but then rebound way more than what people realize as well. So I can kind of see that because of the magnitude of the hammer that's been put down, there's going to be a band-aid of equal or greater proportion, which will exacerbate the underlying illness, which is another podcast episode right there.
Totally.
I don't even go there. So I would say that, hey, Maybe we could see a little bit higher. I kind of don't think it's going to go much higher. I could be wrong here, right? I probably am. Um, Once I thought I was wrong, but I was wrong. But I'm pretty sure I was wrong. And this time I could definitely be wrong. But I would say, hey, if it's 4.85 right now, I see the 1 year rate this time next year, probably around the 5.15. And I
Cool.
kind of see things settling at my kind of general sense for equilibrium in terms of the interest rate affecting the direction of the house price growth rate. I see that as probably around 4%. So that's not too far off what you're saying as well. And I'm basing that just off of the sensitivity to debt levels, right? Because people talk about the income to house price ratio. It's all about the income to mortgage repayment ratio that no one talks about. That's the relevant piece that needs to get into equilibrium. And I kind of feel that's around about the 4%. But again, I definitely could be wrong, because I never actually honestly thought that interest rates would get this far this cycle.
Mm,
I believe that ultimately we are in a long-term declining trend still. So long-term, I don't think this is a reversal of a 40-year trend. I see this as a natural sort of cycle within a long-term channel that's eventually going to go to zero. Um, so I think we can fold a bit of paper in half quite a few more times from here on in, and this isn't coming to a head or anything. So I'm not saying everything's going to explode, but I do see that interest rates are going to fall back to a significantly lower position ultimately in the long term again. That's why
yeah.
property is the way to go.
Yep. Yeah, and I mean the I know the US mortgage rate market is a completely different beast. They do much longer terms than we do, but they've been around the under 3% for a long, long time, right? Probably since before the GFC. So that kind of settlement at a lower rate is completely possible without, blitzing the market, I think. Yeah.
Yeah, I
It's
think so. Time will tell,
yeah,
right? It's a funny
yeah,
old beast. The way that the money works in the world, it's just such a weird thing. And
yeah,
it is very, very connected. Like I've kind of been really trying to understand this. Man, I do not recommend it. Try to like definitely do not try to figure out how the whole thing works, because it is insane. But if you can kind of figure out a couple of little pieces of strands and untangle that knot, you can kind of see that you can sort of make sense for and provide reasons as to why things move in the way they do
mm,
at the rate and the rhythm and the cadence at which they do. You can kind of figure that out a little bit. And I think that's kind of the art for everyday investors, is to really get a sense for where they fit in that cycle. And I'm not suggesting that you have to be actively timing the market, maneuvering all the time, but you do have to kind of get enough of an understanding where you get into the rhythm of what's happening around you without being in too much conflict with it, because the market will do a lot of the heavy lifting for you when you're building wealth. This is my view, as long as you're not, raging against it too much. You
yeah,
need to be understanding it for what it is, not what you think it should be based on your moral lens that you're looking at it. But once you kind of see it for what it is and move with it, again, and what I'm saying is, hey, if you can, you should be buying property. And if you can buy more than one and you don't think that's a bad thing, because it isn't a bad thing, then you should totally do it. That's what I'm
yeah.
talking about.
Yeah, and as you say, we've probably got a couple of months if the triple CFA changes give a return to the availability of finance. You've probably got a couple of months if you are approved today to buy before the buyers return to the market. So you'll get summer, you'll get the banks getting a grasp on what the new rules they're under with the triple
Yeah.
CFA. Then you
Yeah.
will start to see people at open homes again. So you've only got a limited amount of time to
Yeah.
get into a quiet open home, I think.
Oh,
And of
totally. And
course,
that is so
yeah,
important, Rupert, as well, because so like, I don't think I don't think you're saying, hey, we should have sold and be renting now, and then we're going to get back in the market. I don't think you're saying that, but I think what you're saying is that for those that are genuinely on the fence as to whether you should do it, actually now is a fantastic time to get ready to do it,
yeah,
regardless of what your timing is. Like, you should be getting ready to do it, because a home purchase is a long-term hold. Ideally, it's not a speculative play. So even if it goes down further, that is irrelevant, because we
yeah.
know that long
Unless you're a
term.
flipper or something, yeah.
Yeah.
If you're a property flipper, then hopefully you're professional enough to know what this market's about. But yeah, most people who live in houses live in them for 5, 7 years, right? Um,
Yeah, that's right.
Yeah, it's and I think we haven't spoken much about the value of property. There's we could almost do a whole episode on that as well. I was on property panel with Carmen from Velocity the other
Oh, yeah.
day, and she had some amazing insights into the way that property values are measured, right? So often reported as the median number, but the median it could tell you that more lower priced houses are being bought, so the middles come down. It doesn't necessarily mean that one house was valued less than it was a year ago. That's not what the median tells you.
Yeah.
But it kind of appears that when it's reported. And so but I think at the end of it, you pay what you think you're happy to pay for it and what will win it, and hold it for 5, 7, 10 years or infinity really is often the best number. And historically speaking, I don't know if you have.
Infinity and historical in the same sentence. I don't know how well that works, but
I think I might have created a time loop there. Yeah.
There we go.
But basically, if you've ever sold a property, you never go back and have a look at the value of it ever again, because it's just a disappointment. But,
Exactly.
But
I think that's really, really important. What you were saying, and I know we probably have to finish up here soon, but what you were saying around the like the data that comes out, it kind of doesn't tell us the whole story. You kind of have to look at it from a quantitative, but really a qualitative perspective as well, and realize that, hey, with the triple CFA and the interest rate piece that we've been talking about, that totally affects property prices. However, it's not a homogenous market. We think of property as it's all the same. It's not. It's just a whole bunch of non-fungible properties. They can't be interchanged with each other. But there are layers. There's layers of property types, and there are some layers of property levels, property price levels, that are far more susceptible to swings in LVR policy coming out of the Reserve Bank and interest rates and lending availability. But when you get beyond that, my view is that eventually you're going to see a separation where higher value properties become far safer to own than lower values. And those price points are different subject to the region that you're in. But that is a really interesting, I think it's a really important distinction to keep front and center, because those that are in high value properties or looking for a high value home, I believe, are doing so with far less risk than those on the lower side of it.
Yes. Yeah. Trying to get on the ladder involves a lot more risk. Yeah.
That's unfortunate.
All right. Let's wrap it up there. Thanks for coming on. For everyone watching, check out the podcast New Zealand Everyday Investor. You're on YouTube as well.
Yes, NZ Everyday Investor. Yep.
Right. Okay. And so and again, we've got Mortgage Lab for the YouTube channel and Mortgage Lab for as a podcast. Just a secret tip: the podcast is really just the audio of our YouTube channel.
Oh,
so
the mystery is ruined for me, man. So it's like the Wizard of Oz.
I know. Pay no attention to the editor behind the curtain. But thanks for watching, everyone, and we'll catch up with you next time.
Thanks for having me on, by the way.
Cheers.